Hi, I'm Tony Filippone, President of Rockford Retirement Planning. I wanted to make this short video for you to keep everyone updated on what's going on with the Federal Reserve and their interest rate decision that came out today. The Federal Reserve recently decided to cut the federal funds rate by 1/4%. Now, on the surface, that may not sound like much, but it has real consequences for retirees and those who are preparing to retire in the coming years. Interest rates influence everything from returns you can earn on your savings to the cost of borrowing, even to the stability of the broader market. And when you're at or you're near retirement, these shifts matter even more. So let's break down how this decision could affect your retirement strategy. First of all, market impact. Lower rates sometimes are good. They can encourage borrowing and spending, which may drive markets higher, uh, but it also can increase the volatility, impacting portfolios tied heavily to equities. Um, Income from savings. Well, reduced rates often mean lower yields. That means you're going to maybe see less interest on your savings accounts, your CDs, other interest-based vehicles, making it a little bit harder to generate reliable income from conservative investments in retirement. Bond portfolios. How are bonds affected? Well, when interest rates go down, typically bond values will increase. So that could be a good thing, but it also reduces the new income that you can earn from buying bonds. So if you're laddering bonds, it can lower your future returns on those bonds. Inflation considerations. This is a big one. This is one of the reasons why we've seen rates where they are. There's been an effort to slow down inflation. Well, with lower rates, inflation is arguably not as under control as maybe some people would say or would like it to be. Uh, it's it's still it's hard to know these things until some time has passed. I apologize, my phone is ringing. But yeah, so inflation is a consideration, and the fact that they lowered rates, could that affect inflation in the future? Yeah, and that can affect your purchasing power, right? That means your money buys less over time. Borrowing costs for those of you who are looking to borrow money, maybe a home equity line, some kind of loan. Lower rates could be good, could reduce costs, but only if borrowing is done strategically and wisely, of course. Um, let's talk about that volatility. We mentioned it briefly that it could create volatility in the market. Well, that affects different people at different phases of their retirement planning. So if you're in the, that saving phase where you're still trying to accumulate assets, interest rate cuts can fuel that volatility, the up and down of the market. And if you're still in the accumulation phase, that could be a good thing because you could take advantage of some of the dips that may occur in the market. However, if you're in that transition phase where you're just getting ready to retire, that volatility can be sometimes your worst enemy. A sharp downturn early in retirement can deplete your savings faster than you expected. If you're drawing from investments at the time, at the same time they're losing value, uh, we call that sequence of returns risk if it happens early in the retirement stream of time, and that can really wreak havoc with how long your money's going to last. Years into retirement, if you're already retired and you've got a couple of years under your belt, how does this affect you? Well, volatility can disrupt reliable income streams that you've grown used to having. If you don't have a protected income source or strategy for smoothing out those distributions, you could run into problems. So the right thing to do is always to diversify the portfolio. A mix of equities, bonds, annuities, other tools can really help balance lower yields and rising costs while supporting your long-term goals. So in short, interest rate decisions like this one may seem technical, but for retirees, they can make the difference between steady confidence and financial stress. So a 1/4 point can impact your savings, your income, and your overall retirement timeline in ways that maybe you might not even expect. And that's why it's so important to understand how these shifts can affect your plan and to make adjustments, before they start to create problems. So if you want guidance on positioning your retirement strategy for a changing interest rate environment, give us a call. We're at 815-633-9595, and we'd love to talk more, and we're here to help. Thanks.